make no friends in the pits and you take no prisoners. 1 minute you're up half a million in soybeans, and the next, boom, your kids don't go to college and they've repossessed your plenty. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
Call in now. 855-4-SHIP.
That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories,
Your freedom.
the Peter Schiff Show.
Welcome, everybody. This is Peter Schiff here on the Peter Schiff Show on Tuesday after the three-day Labor Day holiday. Although while the U.S. markets were closed to celebrate Labor Day, and of course what a fitting day to celebrate, way to celebrate the American labor movement movement by not working, which is what the labor unions have promoted. But when we were taking a day off, the European markets were open and getting clobbered, and that has resulted in a much weaker opening here in the U.S. You know, U.S. Stock market futures were down quite a bit on Monday. They didn't recover any ground this morning. The Dow Jones right now down 220 points, just at about 1,100 even, although that is about the high we've been this morning. We were down lower. We were down at 10,950 or so just about half hour ago or so. That was about the low. And if you look at the Dow Jones, if you look at a monthly chart, the pattern is one of a rising wedge, which is a very bearish technical pattern where after making a big drop, you rise in value with a series of higher lows and higher highs, and you form kind of an upward sloping wedge. Generally, that pattern is bearish, and when it ultimately breaks, it's a continuation of the previous trend, which in this case is down, and it would at least project to a retesting of the lows from August 9th, which was around Dow 10,600. I tend to think that those lows will not hold, and we'll get a lower low. I don't expect the market to fall apart. I've kind of had a target of around 10,000 on the Dow. I just think that there's going to be too much inflation, too much manipulation of currencies and attempts by governments to artificially prop up stock market for the nominal decline to be that much more dramatic. That doesn't mean that it can't happen. Certainly we can see a more dramatic decline beyond the 10,000 level. I just think that if you're trying to handicap it like an odds maker, that the odds are that it won't be as dramatic as 2008, at least in nominal terms. In gold terms, it could be every bit as dramatic, in fact, far more dramatic as the stock market continues to make new lows. In fact, let me take a quick calculator with the 11,000 Dow and gold right now at a new all-time record high. Let me do this calculation. What is gold at? Yeah, we are below 6 ounces. We're near or close to a new record low in the gold price of Dow, if not all-time record low, but a record low for but a low for this bear market, which began in 2000, where the Dow was worth 43 ounces of gold. So when you put the bear market, when you define it in terms of gold, you can see a much bigger decline than when you simply measure it in terms of depreciating U.S. dollars, which brings me, I think, to the real action in the markets today is in the currency markets. The big news is with the Swiss franc, and it's particularly timely. For those of you who don't get my newsletter that I put out through my precious metals company, Euro Pacific Precious Metals, you should go and subscribe to it. It is free. And last week, the lead article in the letter was the one that I wrote, and it was called The Last Safe Haven Standing, in which I explained why gold was going to benefit from its competitors in the safe haven arena, meaning the Japanese yen and the Swiss franc. Their government's trying to undermine the appeal of their currencies, and that is exactly what happened last night with the Swiss franc. The Swiss basically announced that for all practical purposes, they're joining the Eurozone. When the Eurozone, the Euro currency was first put together, Switzerland, rightly, opted out of the process. They did not want to give up the sovereignty. They did not want to surrender the Swiss franc and adopt the euro, so they wisely stayed out of it. Now, because the euro is falling apart, which is precisely why the Swiss decided that they didn't want to play, now they decided to jump off the same bridge as their European allies or partners, and they basically said that they were going to print as many Swiss francs as they have to keep the relationship at about 1.2 to 1 versus the euro. As a result, the Swiss currency is down today about 8% against the dollar. Since the euro itself is down, the Swiss franc, let me see, is it 8%? Yeah, it's 8%, 7.5% now. It's rallied, but it's down 8.5% against the euro. Of course, it's down almost 10% against gold. This has got to be the single biggest daily decline in history. I mean, I could be wrong. I didn't research it. Maybe if anybody else wants to look through the numbers. But this is a near 10% depreciation, devaluation, however you want to describe it, in one day of the Swiss franc in terms of gold. And so you have the Swiss now deciding that they are going to effectively adopt the euro in the same way that the Chinese have adopted the RMB, although the Chinese are very slowly learning from their mistakes, and they're allowing the RMB to appreciate, although much more slowly than they should. The Swiss decided that they think that currency peg works so well for the Chinese that they want to adopt the same policy over there in Switzerland. And so now, every time the European Central Bank decides they want to buy some Greek debt or some Italian debt or some Portuguese debt, the Swiss citizens are going to be chipping in to that bailout pot as well, because the Swiss National Bank is going to have to keep printing Swiss banks to buy up European bonds to defend this new peg. And so what does that mean for the Swiss? That means that their currency will be worth less than it otherwise would have been. That means that prices will be higher for Swiss citizens, and ultimately it will undermine the very competitiveness of the Swiss industries that Switzerland thinks that a weak currency is going to support. And really what this is showing is the breakdown of this fiat monetary system that we have, where, one irresponsible country's monetary policy infects another. We infected the Chinese with our inflation. Europe is infecting Switzerland and corrupting Switzerland. The whole world is being corrupted. And, of course, the last safe haven standing, the only real money that no central bank can print, is gold. And as I said, gold is at a new all-time record high today, which also throws cold water on all that bubble talk from a couple of weeks ago when gold went back down to about 1650, which, by the way, if you go back and listen to these shows, I thought 1700, 1650 would be the bottom in the gold correction, and I pretty much called that. But anybody who was saying that gold was a bubble is proven wrong conclusively today. At least, no, maybe not that. Anybody who said that the bubble had popped. So it is still possible that gold is in a bubble. I don't think so. But the people who said that that bubble burst, like Dennis Gartman, are clearly wrong. Because if the bubble had burst, by definition, gold couldn't make a new high. So the fact that gold has made a new high proves that Dennis Gartman was once again wrong on his call that the gold bubble had burst. Anyway, stick around. We got a lot more of the Peter Schiff Show coming up. You're listening to the Peter Schiff Show on SchiffRadio.com. Stick around.
Peter Schiff Show. Since the Peter Schiff Show was last on the air, the national debt added another $7.89 million.
Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
And we are back, and again, talking about the currency markets, the precious metals market, as gold is off to a new high today. Silver prices are backing off. Again, silver seems to be selling off with the industrial commodities, although not as bad as some of the others. And I think that, ultimately the monetary element of silver will win out over the industrial element, although ultimately I think industrial commodities are going to rise as well because of the massive tidal wave of inflation being unleashed by central banks all around the world. Gold stocks, though, continue to strengthen. As I mentioned earlier, I thought that the positive divergence in the last correction boded very well for both the metal and the stocks. Gold stocks, the Huey, at a new all-time record high, above 630 for the first time ever. Another index of gold stocks, the XAU, that one has yet to make a new record high. It is at the highest level it's been since May of 2011, which also happened to be its record high. So I think that index, too, will ultimately make a record high. In fact, not ultimately. I think it could do it this week. I mean, it's not too far away. I think it's less than 5 points or 7 points away. So it doesn't take much for that index to join the Huey in record territory. Another market that is showing record moves, the Treasury bond market. That is where the real bubble is. That is where the real insanity is going on. The yield on the 10-year is now at a new low. We're at 1.936 on the 10-year. The 30-year yielding 3.198. Really is a crazy situation, likely to get a bit crazier if you look at the short-term chart, because the absolute low that the 30-year made, the 10-year is at a new low for the, in our lifetimes, but the 30-year actually got lower in December of 2008. The yield on the 30-year actually got down to 2.519%. So we're now at around 3.2. So that's kind of like the target. I'm wondering if we can get down there. I mean, it seems like we can. And maybe what I've been hearing rumors about is one of the things that Ben Bernanke wants to do in his next round of inflation trading is to concentrate even more heavily on buying long-term bonds rather than short-term, and that might push the yield on the 30-year bond temporarily down to those lows. Of course, the larger the Fed's balance sheet, or the bigger the percentage of the Fed's balance sheet that is composed of long-term bonds, the harder it is for the Fed to ever shrink that balance sheet, because that means it has to sell those bonds. If it has short-term bonds, it doesn't need a buyer. It can simply let the bonds mature. But when it has 30-year bonds, and if it wants to shrink the balance sheet, it actually has to go into the market and find a buyer for those 30-year bonds, which, of course, could crush the market and send rates skyrocketing. But, of course, the Fed doesn't care about how much long-term damage it inflicts on the U.S. economy. All it's concerned about is how can we get this current crop of incumbent politicians reelected. And obviously, politicians are losing popularity. In fact, Barack Obama, the poll numbers were out today, and his popularity is now a low for his presidency. It's down to 44%. And on the economy, he's only got an approval rating of 37%. Now, to put it in perspective, though, if you remember, George Bush, when he left office, had a popularity of just 22%. Approved of the job that George Bush did. And, that wasn't even a record low. It was the second lowest popularity of any president, and that was Truman. I didn't even realize this till I looked it up, but Truman, when he left office, his popularity was down at 20%. So that's an incredible record to shoot for. The key is, will Obama popularity be down that low if by the time he doesn't get reelected, if that is the case in 2012? I don't know. It's a tough record to break. George Bush took a good shot at it. Things really fell apart under the Bush presidency. I think the economy will be in worse shape when Obama potentially leaves office. Certainly, if he leaves office, 6 years from now or 5, it'll be in abysmal shape. But I believe when he leaves office, the economy will be in worse shape than when Bush left office by just about every measure. But the question is, will the public be smart enough to blame him for it? Chances are no. So chances are that the Truman record will stand, even though Obama will give it a pretty good run. But anyway, so going back to the bond market. Bond rates going down. Again, this does not bode well, too, for what is happening in the U.S. economy with the jobs. And, in fact, if you look at the financials, I mean, the banks are really, really getting beat up today, all of them. And, again, the government decided that they're going to be filing lawsuits. I went over this on my show on Friday. Think about all the stupid things that they've done. This is just piling on and more of that. One thing I want to talk about really quickly, and I'll see if I can grab some calls. We do have a guest coming up at the top of the next segment. But I watched a report on YouTube on Russia Today, and this was in RTTV, and it showed Detroit. And, of course, Detroit was an incredible success story. It was a city built by capitalism that has been destroyed by government, by regulation, by labor unions, and all the things that we have done. And this once great city, all of their structures, these factories and office buildings that were vibrant, that were productive, are now abandoned. And what's happening is all the unemployed people and even people who have jobs who live there are basically looting these structures to take whatever scrap metal they can find to then go and sell. You know, we're basically dismantling our own economy to just survive. You know, talk about killing your cows, your dairy cows, and eating the food. You know, we're eating the seed corn. It's the country is basically imploding in reverse. Right, this is what big government, this is what all these labor unions and all this government protection. I pointed out on an earlier show that almost 100 years ago or 90 years ago, whatever it was, that when Henry Ford was pioneering making the Model Ts in Detroit, when there were no labor unions, when there was no minimum wage law, he was paying his workers the equivalent, adjusted for the decline in the value of the dollar, of $100,000 a year. And they had no taxes. That was tax-free money. And we had a vibrant economy. We built up that country, that city, and now we're watching it disintegrate because of government. And, you know, back then when those auto workers were earning $100,000 a year without labor unions and without a minimum wage law, I bet that there was probably maybe not even a single auto worker, but maybe just a couple who were married, who had kids, whose wives had a job outside the home. Today, probably just about every single auto worker who has kids has a wife who's also working to support those kids, because the money he earns with all the labor unions, all the government protection, all the things that we have supposedly done to improve the lot of the workers, that worker still cannot support a wife and family the way his grandparents or great-parents could have done when it was capitalism that was determining wages and working conditions, not government and government bureaucrats trying to save the worker. They have destroyed him, and that's really what people should have commemorated on Labor Day. It really is a day of mourning, to mourn the loss of the wealth and the purchasing power and the liberty of the American laborer, who's been sacrificed on this altar of socialism and altruism and all whatever isms you want to throw in there. Our lot has been completely diminished by what we've done. And you know what? It's going to get a lot worse, because the currency crisis, I think it's coming. It's only a matter of time, and it's not going to be decades. It may not even be years when the dollar really plunges. It's not the Swiss franc that gets killed, but the dollar. And then the last hopes of American workers go down the drain. Anyway, stick around. We got a guest coming up. We'll be back with more of the Peter Schiff Show here on SchiffRadio.com.
Schiff Show.
We now return to the Peter Schiff Show.
Call in now, 855-4-SHIFT.
That's 855-472-4433.
The Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff here at SchiffRadio.com. You know, we got a lot of people waiting on hold, and I guess I didn't get to any of the callers in the first segment of the show, so I apologize. But stick around. I promise I will go right to the phones at the top of the next hour after my guest has left. But anyway, joining me now is Jimmy Adams, and Jimmy's got a very interesting story. He worked for many, many years in financial services. He was working for a life insurance company, a money management firm. He was involved in trading of bonds, of mortgages. He worked most recently, or at least in Wall Street most recently, for a hedge fund. He was laid off in 2009, I guess, early in the Obama administration. But he got one of the jobs that the Obama administration was able to create. So I guess maybe we could give President Obama credit for Jimmy's job working as a waiter in a waffle shop. Obviously, probably a big step down. I don't know how much the tips are there serving waffles. Probably not as much as he was able to rake in on Wall Street. But anyway, yeah, he's got an interesting story, so we thought we'd bring him on and discuss his journey from Wall Street to the Waffle House, and maybe he could discuss the lessons he's learned along the way and the similarities between Wall Street and serving waffles. Anyway, Jimmy, welcome to the show.
Thank you so much for having me, Peter. I appreciate it.
And so, first of all, I mean, what were the circumstances surrounding, what happened at the hedge fund where you were most recently employed, as far as how you left? And did you try to find another Wall Street job, or how did you end up, as a waiter?
Well, as you mentioned, I was laid off in early 2009. It was the third wave of layoffs we'd had at the firm. We had managed north of $30 billion in fixed income assets for pension funds, insurance companies, banks, sovereign wealth funds, you name it, we did it. And at the time of the layoff, I think that was late January 2009, I'd been watching the debt crisis unfold for the previous 2 years, really. So by the time, the equity market sort of woke up in late 2008, the handwriting had been on the wall for a long time as far as I was concerned. And quite frankly, the layoff came as something of a relief because I was so sort of disenchanted with the whole financial services profession, and in particular, the inability of anyone to really explain what was going on. So I decided I needed some respite from the financial markets first and foremost, and I decided I didn't want to return until I was able to figure out a little bit better what was going on and sort of how the system worked.
Yeah. Now, did you spend any time collecting unemployment, or did you just go right to the waiter job?
Well, I did go to the unemployment office, and in fact, it was, I think, my second time back there. I got to talk to the guy that ran the Raleigh branch of the North Carolina State Employment Commission, and he had mentioned that basically their coffers were depleted, and they were going to have to go to Washington for more money. And I had talked to some other folks in the lobby earlier that day that had worked in construction, and you get to talk to these people, and you realize that my firm had been financing, a lot of those construction projects in Florida and Phoenix and elsewhere, sort of facilitating that misallocation of investment, if you will. So I just felt really bad about cashing the check because I felt like, I, at least in some small degree, was partially responsible for the conundrum we were in, and so I decided to just take some a leave of absence from finance and try something totally different.
Yeah, now not to demean the profession of waiting tables, but was that the best job you could find? I mean, there was nothing. I don't mean to pry, but I mean, how much what are you making serving waffles? Well,
as a waiter, I think and I don't know if this is a state minimum or what, it's $2.13 an hour plus whatever tips you earn. So on average, I don't know, maybe that worked out to $8 or $9 an hour. I was assigned to the weekend graveyard shift, and after the bars close, things get pretty colorful, and you're just lucky not to have grits thrown at you some nights as opposed
to like I gotta
worrying about tips is the last thing on your mind sometimes.
Yeah, I can't imagine too many people doing what you're doing. I think I'd rather just collect unemployment. I think it sounds like a lot easier way to make a living, than having to go out in the evenings and take the abuse. I know a lot of waiters. I mean, a lot of people are, it's not the easiest job. I don't think I could even do it. But I mean, you didn't look for anything else? I mean, did you send out resumes for higher paying jobs or?
Well, here's the irony, Peter, is I thought that I wanted to do something, unrelated to finance. I thought, well, maybe I'll look into becoming a franchisee. In fact, I had actually talked to some folks that ran a local McDonald's franchise. I knew they could do pretty well. So I thought, well, maybe I'll go into business for myself and learn a little bit about food service. Maybe become a restaurateur down the road. But I need to just explore what else is out there outside of financial services. And in fact, I applied to McDonald's on 3 separate occasions. I talked to the assistant manager, the manager, and the franchise owners, but they wouldn't hire me. So the Waffle House thing was kind of a lark, actually.
Now, why wouldn't they hire you? They think you were overqualified? Was that the?
They never gave a reason. Actually, they just didn't call me back. So.
Yeah, pretty soon the government is probably going to pass a law making it illegal to discriminate against the overqualified. I read that their government is now contemplating, not only making it illegal to discriminate against the unemployed, but now if I heard something that they're thinking about making it illegal to discriminate against ugly people. I mean, all they're trying to do is think of ways to allow people to sue people who make the mistake of trying to hire somebody. And I think, the advice I generally give, and if you're thinking about trying to find a way to start your own business, probably one of the best things you can do is try to figure out a business that you don't have to hire anybody, because at least you don't have that crosshair on your back. I mean, hiring people is one of the worst offenses that you can have. You become a second-class citizen the minute you become an employer. And you're going to be there's so many different ways you can get sued and penalized. It's very risky. But anyway, so how long have you been working as the waiter?
Well, I worked there for about 6 months. So yeah, that was about a 6-month stint I did at the end of 2009. Subsequently, I worked for a financial services software company, and now I'm moving into the retail side of the financial services business.
All right, so you did manage to find another job back in financial services. So maybe I misspoke earlier, assuming that you were still waiting tables. So, what kind of perspective did you gain on Wall Street from the time that you spent on Main Street?
Well, it's really quite ironic. I thought that I'd accumulated all of these amusing anecdotes waiting tables, and I felt that the financial crisis sort of needed a whipping boy outside of the ones that hadn't placed themselves in that situation. Angela Mozillo and Bernie Madoff and people of that ilk. I thought, well, here's an opportunity to sort of have some fun at the expense of one of the parties that's sort of responsible for this housing and mortgage crisis we're in. So I thought that I'd accumulate all of these notes and get it published. But the odd thing was, over the course of working at Waffle House, I learned a tremendous number of economic lessons. A lot of them from some of these ex-convicts that I worked with that were just so grateful to have the opportunity to work again. First and foremost, the idea that, if you're not able to work at a normal job over the course of 10 or 20 years, the only employment you can get is in a prison kitchen or laundry. A lot of these guys came out and they'd mellowed a lot, since the time they were initially convicted, and they were just so grateful to have the opportunity to retool, learn a new skill set at community college or whatever, and a lot of them were doing that on the side while they were, initially working at Waffle House as they finished their parole. So it was very humbling to me to see people that were just so grateful to have the opportunity to work and had the initiative to learn the skills that the market demanded. And the irony was, as I was working at Waffle House, I spent a lot of time reading as much economics as I could. I read a lot of folks from the Austrian school. I enjoyed your book, How an Economy Grows and Why It Crashes. And I realized that a lot of the values and ideas espoused by these guys that I worked with at the store were the same ideas that were being articulated by Jean-Baptiste Say, David Ricardo, John Stuart Mill, a lot of these classical 19th century economists. They basically saw unemployment as a mismatch between the structure of demand and the structure of the supply. And so the real issue to growing an economy and making markets clear was figuring out what specific items people wanted, delivering them at the right places and at the right wage. And it just blew my mind when these guys would sort of espouse these views in casual conversation, and it would remind me of something I had read from Jean-Baptiste Say the previous night. It was mind-blowing.
Yeah,
So
it sounds like you got yourself a good education there in the Waffle House. Maybe more people on Wall Street need to make that round trip. And I understand that you turned your experience into a book. I'm looking at it right now on Amazon. Waffle Street looks like it's got some good reviews, and according to Amazon, there's only 9 books left in stock. So if you want to order it on Amazon, I guess you got to buy quickly because they're almost out. But anyway, we'll come back after this break and discuss your book in depth and more of what you learned from your experiences in Main Street and then the lessons that can be applied to the people on Wall Street. So stick around. We will be right back with more of the Peter Schiff Show here on SchiffRadio.com.
The Peter Schiff Show.
To President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America.
We're sorry. Peter Schiff is back on the air.
Welcome back, and we are talking with reformed Wall Street guy, although back on Wall Street again, so maybe reformed is not the correct word, but he had a soul-searching experience serving up waffles and turned it into a book, Waffle Street. The reviews, on Amazon are really, really good. There's not that many yet. There's 25 reviews, but of the 25 reviewers, 22 people gave it 5 stars, and 2 people gave it 4 stars. So those are pretty good reviews. I don't know if you've read any of them, but seems like you're getting a favorable response to the book so far, Jimmy.
Yeah, it's funny because I noticed a couple months ago I got my first 1-star review, and I read it. The guy says, James Adams is condescending. He thinks he's better than everyone, blah, blah, blah. I thought, boy, that's a lot different from what the average reviewer, assessed the book. And so I went and I Googled the guy's name. It turns out he's a professor of economics at a local college, so I sort of wear that review as a badge of honor.
Yeah, that happens to me. If you look at some of my books, I find a lot of the 1-star reviews come from people that didn't even read the book, and they're just people that have an agenda, and they want to try to discredit the book. And so that might be what that individual was trying to do.
Well, yeah, I think, the analogy I use is if, I'm the little kid that's calling everybody's attention to the fact that the emperor's naked, and you're the emperor's tailor, I'm probably not going to get invited to your Christmas party, right? But
probably not.
Everybody knows the emperor's naked. Everybody knows there's something wrong with the economic theory and the way we go about addressing the problems, because all of the traditional mechanisms, both fiscal and monetary, are no longer working. So that's why it opens the gates to all of these.
Yeah. And see, my thing is, I don't think they ever worked. I don't think the money printing and the Keynesian stimulus ever worked. All we did is spend up our wealth, and now we're broke as a result of all these phony cures that never worked, but paved the way for the dire situation that we're in today. And now, of course, we've decimated so much of our wealth and so much of our productivity, our productive capacity, that there's nothing left to decimate or to, so now we're going to ultimately have to reap the whirlwinds of what we've sown. So it's not that the policies don't work. They've never worked. It's just that we've reached the end of the line, right? We've kicked the can so far down the road that we've run out of road, and that's it. And now we're stuck. We're stuck where we are.
Yeah, that's exactly right. The Keynesian, quote-unquote remedies, at the end of the day, they just buy you time. But they never really address the fundamental issue of recession, which is reallocating capital and labor from where they're no longer needed to where they're most needed. That's what has to happen.
And, of course, what does Obama want to do now? He's about to make his speech on Wednesday or Thursday, rather, about jobs, and he's supposed to announce, some big infrastructure spending plan or, some private partnership where the government's going to direct capital at, fixing up the schools or some other tax cuts. But where's all this money coming from? We're not going to get all this for nothing. It's kind of like if if someone is unemployed out there and they decide that they're going to follow their own infrastructure program, and so they decide they're going to put in a swimming pool and they're going to build it themselves, and so they're going to take out some loans and the guy's going to spend all day long building his own swimming pool. But the fact is, all of that labor and capital might have better been utilized more effectively. I mean, the swimming pool is nice to have, but maybe if you're broke and unemployed, it shouldn't be high on the agenda. Maybe you should do something else with your labor and your capital other than put it in a swimming pool. And, of course, to make it a total Keynesian stimulus package, once he was finished building the swimming pool, he would fill it back up with dirt, rendering it completely useless.
Yeah, that's right. It's funny, we laugh about this, but the horrible, horrible truth is that, Paul Krugman is writing editorials in the New York Times, it was in Fareed Zakaria at GPS, saying that an alien invasion would provide economic stimulus. Like this guy.
Yeah, I know. I made a joke of
right?
that. Yeah, I know. I made a joke of that on my show. It's like when he watches movies like Independence Day, he goes, "Oh, great! Look at that! What a stimulus that was! They leveled the whole country. That is great for us."
Yeah, well, to me that's. I think why I have this sort of missionary zeal about, sort of the book and getting these ideas out there, and why I enjoyed your book, How an Economy Grows, and why it crashes so much, is that this stuff is really not rocket science. It's just that for the last 7 decades, we've been teaching, so much nonsense at the university level where, it's sort of down is up, black is white, bitter is sweet. And it's crazy. And the irony is that the common sense of these guys that did 20 years in prison can just decimate all of these Keynesian arguments. And so I just have such a missionary zeal about getting these ideas out there. And so what began as a self-deprecating narrative sort of morphed into something a little more, I think, meaningful.
Yeah, and that's why the college professors, they don't like your book or they don't like my book, because it proves that, it's a waste, what they're doing is a complete waste of time, that you could just buy a short book and read it for 3 hours and learn a lot more than you could majoring in the subject at an American university. But you mentioned you were reading, these classical Austrian economists. Had you been reading them while you were still working at the hedge fund, or did you discover the writings once you left Wall Street and began serving up the waffles?
Yeah, so just a little bit of my academic background. I spent, I think, 3 semesters in macroeconomics at Wake Forest, very interested in that subject, but ultimately majored in finance. I subsequently got the Chartered Financial Analyst designation and then an MBA from the University of North Carolina at Chapel Hill. So I had a pretty, what I felt was a pretty good, sort of robust education in finance and economics. I did not really gain exposure to anything in the Austrian school until, I believe it was 2007. A fellow I worked with introduced me to the von Mises Institute and that website. Incidentally, Doug French just gave a glowing review of Waffle Street on his site. Doug's the Mises Institute president, so I was very pleased to read that. But no, I really hadn't delved into a lot of the sort of 19th century writers that provided the basis for the Austrian school. I'm not terribly well read in Hayek or von Mises, but I know I've read a fair amount of Murray Rothbard and Jean-Baptiste Say, who Rothbard speaks of very favorably.
Mm-hmm. Yeah, I read some of his writings even a long time ago. My dad first turned me on to him. I remember I read books of his, I think some of the shorter works back in junior high school. So he had an influence on me a long time ago. Maybe had you been introduced to that type of thinking in your college years while you were working in Wall Street, you might have been more valuable to helping to educate your coworkers to see the bubble before it burst, and maybe do something about it while they had an opportunity, and maybe you wouldn't have had all those layoffs over there at the hedge fund.
Yeah, I mean, I know you were very prescient in a lot of the comments you had made, but I think that's the problem, is that the common sense was sort of on the lunatic fringe, right? Because the sense we had, and I think it was pervasive throughout Wall Street, is if you got in a pickle, the Fed could do enough that would basically, extricate us from any problem we got in.
I know the owner of that Waffle House knew that if he lost money, he wasn't going to get a bailout. So he had to make sure to hire the right workers, the right wage, to serve the right type of food to make sure he satisfied his customers, because if he didn't satisfy them, he'd lose them, he'd go broke, and there was no bailout money waiting for a restaurateur because he didn't have the type of connections. But anyway, he had one good employee at least. Thanks for being on the show, Jimmy. I really wish you luck now that you're back on Wall Street making some better money, I hope, and I think you learned a lot from your experience, and you're obviously parlayed into a book. So I congratulate you on that. Everybody else, stick around. We'll be back with another full hour of the Peter Schiff Show here on SchiffRadio.com.
The Peter Schiff Show.
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
Call in now. 855-4-SHIP.
That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories,
Your freedom.
the Peter Schiff Show.
And the second hour of the Peter Schiff Show is underway now, and we will be going almost straight to the phones. First, just want to make mention of the fact that tomorrow night we do have a presidential debate, the first of a series of presidential debates. I think we actually have three in the month of September, beginning Wednesday night in California at the Ronald Reagan Presidential Library in Simi Valley. This debate is sponsored by Politico and NBC News. Unfortunately, again, the debate will not include one of my favorites, Gary Johnson, but Ron Paul will be there, who, by the way, I think did an excellent job yesterday in the Jim DeMint Republican Forum. You can actually see his 20 minutes Q&A on YouTube. I favorited his segment on my YouTube channel at the Schiff Report. So if you want to spend 20 minutes listening to Ron Paul, he's there. So I will be, of course, watching the presidential debates on Wednesday and be talking about it on the show on Thursday. So if anybody else wants to watch and talk about the show, we will be doing it. Anyway, let me go to the phones now. First up on hold for almost an hour is Chris calling from Stamford, Connecticut. Chris, thanks for your patience and welcome to the show.
Hey, Peter, thanks for taking my call. Could you recommend any gold mining stocks, not necessarily for an investment, but just ones to keep an eye on for a breakout?
Well, a lot of them have already broken out. Many of the gold stocks are at 52-week highs today, and so there are a number of them. I'll just give you a couple that are making 52-week highs. Again, I'm not recommending these stocks, just mentioning a few on my screen that are at new 52-week highs. Newmont Mining is at a 52-week high today. Yamana Mining is at a 52-week high today. There's just a couple. And, of course, a lot of the stocks that aren't at a 52-week high are very close to it. Obviously, Franco-Nevada at a new 52-week high today. So there are a number of stocks that are on the highs, but many stocks are very close to making a new high, and I think will shortly. I think one of the easy things to do is just look at the index. If you just want to follow a group to see what's happening, just look at the HUI, which is the Gold Bugs Index, which is at a new all-time record high today. It's actually been backing off a little bit since the show began. It's now kind of on the low of the day, but it's still up about 8.5 points, which is about 1 1/3%. And that's with the Dow Jones off 2 1/4%, off about 250 points. So again, the gold stocks distinguishing themselves and diverging from the downward moving stock market and following, or maybe even leading at this point, the upward moving gold market.
Is the HUI a basket of gold companies?
Yeah, it's an index that is comprised of theoretically the unhedged gold stocks. That was its initial claim to fame when they set it up. They included the companies that were not hedged, because back then there were a lot of companies that were hedged. Of course, most of the hedgers have unwound those hedge positions, and gave up the practice of hedging a long time ago. Yes, there's still some remnants of the hedge books still around on some of these companies, but hedging has pretty much lost its credibility. It made sense for a lot of years. Companies like Barrett Gold were able to make a lot of extra money hedging during the bear market from 1980 to 2000. But during the early part of this bull market from 2000 to 2005 and 2006, people were being punished from hedging, and slowly but surely the gold companies were figuring out that it made no sense to hedge, that with interest rates low and governments printing money, that gold really had only one direction to go, and that was up. And so, there was no reason to try to hedge gold when people were buying gold to hedge against everything else, particularly paper money.
And that's one other question. Have you ever attempted to get Mike Shedlock, I believe that's his last name, from this blog there on your show?
No, absolutely not. And the reason I don't want him on is I just don't want to give him the forum or the credibility. If he had attacked me in a more professional way, I have no problem with debating critics. In fact, I very much like to have people on the show who have a different perspective, because I enjoy the contention of it, the back and forth. I think it's interesting radio, and so I like it. But I just don't think he has any integrity. I think he basically had a PR plan to try to promote his fledgling asset management company by unfairly discrediting me in ways that he knew that I couldn't refute. And I think he distorted and grossly misrepresented the things that I had said and that I had written, simply to try to profit for himself by attracting clients. And as it turns out, his investment performance has been horrific over the last 2 or 3 years. And so, unfortunately, the people who were attracted to him based on his critique of me, anyone who sent him money has done a horrible job, because for 2009, 2010, and 2011, in general, you made money doing just about anything except following the advice of Shedlock. So, but I don't want to give him any publicity, so I rarely mention his name. But, for people who want to be more fair and honest in their criticism of either my investment recommendation, my strategy, or my economic outlooks, that's fine. I'd have them on the show. In fact, the problem is, though, it's really hard for me in a public forum to debate investment strategies, because I am not allowed to talk about any success that my strategy might have had. So while somebody is free to point out where they think I've gone wrong or where they think I've lost money, I'm not allowed by the regulators to point to anything where I've made money. I can't talk about any money that I might have made, even if I've made it. So it's very hard to debate the investment strategy when I've got my hands tied behind my back. It's hard to win that battle. So but I can certainly debate my economic analysis and my forecasts and things like that, although regulators have recently tried to silence me even in that area. And so I even there, I've been fighting back a bit on that. But even there, they try to encroach on my freedom of speech and try to limit some of the things that I can say or the way that I can say them. So it is very frustrating, to be in a regulated industry the way I am, investment management, which has been very good to me. I've been able to do very well in the business, but it's despite of, not because of, government regulation. And in fact, all of the main problems that I have in my business right now, in fact, the only real problems I have is dealing with the regulations and dealing with all the compliance and all the costs and all the aggravation and all the litigation and all the just waste of resources and efforts that might otherwise be devoted to expanding my business, helping my clients, hiring people. All that is instead being completely wasted on worthless and cumbersome rules and regulations that simply destroy jobs and competition. But anyway, hey, thanks for the call. We are out of time for this segment. We got plenty of people on hold. We will come back with more of your calls as the Peter Schiff Show continues here on SchiffRadio.com, the gold standard in talk radio.
The Peter Schiff Show.
What's the matter with me?
To President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America,
We're sorry. Peter Schiff is back on the air.
Yes, we are back, and during the break, I'm watching kind of a fast market developing in the metals, looking at silver and gold prices going down. I mean, gold, the GLD ETF, is now down about $5 after being up in record territory earlier this morning. Not exactly sure what is inspiring the selling, but also we are seeing buying in the stock market. So stocks are rallying, although it's hard to notice the rally with the Dow down about 225 points, but that's close to the high of the morning. It shows you, or the high of the day so far, it kind of shows you how weak the stock market has been. But there is obviously some money going out, moving around now. Gold down about $7, and so it's fast pulling down the gold stocks, which are now still in positive territory. Despite the gold's decline, the gold stocks themselves are still in positive territory, but they are rapidly losing their gains. And in fact, the Huey Index now is only just under 3 points, around 620. It was trading at almost 635 early in the first hour of trading. Anyway, let me go back to the phones. On hold for, again, almost an hour is Bayo calling from New Jersey. Is it Bayo or?
Bayo. Thank you.
Bayo. Okay, yes, thanks for your patience. Welcome to the show.
Yeah. First of all, I'd like to just say that I have kind of a theoretical interest in economics and how it relates to the world today and so on. So if my questions seem a little bit, don't think about it like I'm just trying to, like I have some plan or economic and financial plan or anything. So my question is this. Okay, first of all, I'd like to say that some of those articles you write, I think they are literary classics.
Thank you.
But okay, so I have a couple of questions. My first question is this: gold bullion bank accounts. Because I was interested in how these legal tender laws affect gold bullion or banks in general.
Yeah, well, I mean, what would happen? The laws that we have on the books now, I think the biggest impediment to gold denominated bank accounts are the taxes that are imposed on gold and capital gains or income taxes based on the sale of gold and silver. Those are probably some of the biggest impediments. Also, some of the laws that were passed pursuant to the Patriot Act and the Anti-Money Laundering Act. So it is very difficult. That's one of the reasons that, my bank that I have offshore, Euro Pacific Bank, is going to be launching the world's first ever gold-backed MasterCard shortly. But it is being done through an offshore bank, and it is not going to give the debit card to any American citizen. So it's U.S. tax law makes it very difficult. But operating from the jurisdiction that I am and dealing with people who are not Americans, then I'm able to do that. And so, but ultimately, that's what we need to do in the United States. If we're not going to at least go back on a gold standard at the national level, we ought to at least repeal all the rules and regulations that are preventing at least individual Americans from adopting their own gold standard and pursuing in that direction. But that's what I'm doing on a global scale.
Yeah. But I wanted to ask, but how does it affect income taxes, though? Because let's say that theoretically, I know there's all these regulations and so on, but theoretically, if someone was able to set up, do a gold MasterCard account, say some bank, I don't know, B of A or somebody, was able to set up a gold bullion bank account using gold eagles and so on. The thing is this: wouldn't all those coins would be legal tender, right?
Yeah.
So wouldn't the income taxes be pretty small from that?
No. The problem again on the income taxes is every time you go and buy something, that would amount to the sale of gold, and that would have a taxable ramification, because now you'd have to look at what was that gold purchased for. And then you'd have to calculate the gain and pay an income tax on it on every exchange. every time, and it would be very difficult to keep track of all your deposits, all your charges, all your withdrawals, and then pay the taxes on it. That is the problem. It's the record keeping, it's the taxes. It's not impossible to do, but then again, you also would have all sides of other scrutiny. You would have all kinds of other regulatory costs that would be borne down on you because the government doesn't like this. The government would look at it as some sort of money laundering scheme or some kind of anti-patriotic thing. I think there's just so much. It's fraught. Anybody that would do it would immediately be under the federal microscope for regulation and who the hell knows. So it just wouldn't happen. It's just not going to happen. That's the problem. And the reason that the government doesn't want this is they don't want American citizens to have an alternative. The government hates competition, right? And they don't want people to be able to protect themselves from what they're doing. Anyway,
and goldmoney.com, is that the same thing?
It's not the same thing, and that is offshore. It's not a credit card. It's more of a barter community, and it's being done outside the U.S., and so that's what's different about it. It's not an American institution. It's offshore, and it's simply people bartering. Of course, it doesn't relieve them of the obligation, theoretically, to have to pay income taxes on any gains that they might otherwise achieve by bartering gold and silver. But anyway, hey, thank you for the call. I know you might have had more questions, but I think I got too many callers to take too many. Let me move on to Maze, who's calling from is that Canada or?
Yes, it's from Edmonton, Canada. It's actually Maz.
Yes.
I just wanted to thank you, Peter. I love your show, and it's really opened my eyes up. Just had a quick question about the fractional reserve banking. I was wondering if you could explain, theoretically, to me, it seems as if, with fractional reserve banking, theoretically, a bank could lose 90% of its investments or any loans that it makes, and it would still be solvent. I was hoping you could explain how these banks...
Well, no, it wouldn't be solvent if that were to happen. I mean, it would be insolvent. So the fractional reserve banking doesn't impair upon solvency. It basically says what percentage of the bank's deposits need to be held at reserve at any given time to be there for withdrawals. I mean, if a bank lost 90% of its deposits, that means it can't honor its deposits at all. So even in a fractional reserve banking system, the idea is that the assets are still there. They're just not there for the immediate withdrawal of their depositors. But even if a bank had a run and it ran out of its reserves, it could still call in its loans and sell off collateral and ultimately meet its obligations. But in the scenario you're describing, meeting the obligations would be impossible because it would have lost 90% of its deposits. But you see, the thing is, in a free market, you always have bankers have to decide between the reputational risk and a run and the profits, the extra profits, because banks make more profits based on how much they loan out. So the more of their reserves they don't loan out, the less their profits. But, of course, the more reserves they keep, the less likely it is that they're ever going to have a run. And, of course, the most important thing about a bank is its reputation. Banks their customers want to know that whenever they go, they can get their money out. So the free market will always strike a fair balance, and the ratio will ultimately be set at where it makes the most economic sense to be. And that's what we had until the government came in. And then, of course, once the government came in, and guaranteed everybody's accounts, then banks no longer had to worry about reputation because the government stood behind all the deposits. And that's when
my question is
the reserves requirement really plunged because there was no longer any necessity to maintain reserves because the government guaranteed all the accounts.
Right. My question is more so about the loans, though. Like, if I was a bank and I took in $10 and I was able to loan out $100, theoretically, whoever I loaned it out to, even if they, foreclosed on their loan.
Yeah. Anyway, look, if you want to hang on, we can deal with this question really quickly. We've got a commercial coming up. You're listening here to the Peter Schiff Show on SchiffRadio.com. Stick around. Just get out of the way and let the gentleman do his
Peter Schiff Show.
We now return to the Peter Schiff Show.
Call in now, 855-4-SHIFT.
That's 855-472-4433.
Radio, the Peter Schiff Show.
Welcome back. This is Peter Schiff here at SchiffRadio.com. Anyway, the gold sell-off is gathering some momentum. Gold's now down about $12. It was down about $18 when this break began. But, the stocks are still hanging in there. The Huey has turned negative, but it's only down about 1.5 points, so it still is holding up much better than the metal itself, which, again, we have been talking about this, I believe, positive divergence. And the stock market continues its rally, in quotes, with the market now down only about 215 points. Speaking about rallies, there was a rally of another sort over the weekend in commemorate Labor Day. I guess Jimmy Hoffa Jr. Was over at the Teamsters rally in Dearborn, Michigan, rallying the troops, so to speak, in a new battle, a new war that he believes the labor unions have to have against the Tea Party, and basically letting the commander-in-chief know that an army of workers stands ready to do battle. Anyway, let's take a listen to some troubling news sound, clip number 1.
We got to keep an eye on the battle that we face, a war on workers. And you see it everywhere. It is the Tea Party. And there's only one way to beat and win that war. The one thing about working people is we like a good fight. And you know what? They got a war. They got a war with us. And there's only going to be one winner. It's going to be the workers of Michigan and America. We're going to win that war. President Obama, this is your army. We are ready to march. Let's take these son of a bitches out and give America back to America where we belong. Thank you very much.
Yeah, let's take them out. This is probably the types of rallies they had, around the time of the Russian Revolution, or maybe the Chinese Revolution, any kind of communist revolution that you have. It's always the workers unite. Who unite against who? The people that are giving them jobs? As if the employers don't work. Employers don't work for a living. They work damn hard for a living. It's because they're working for a living that jobs even exist. So the real war is not against the worker, but against workers who happen to be employers. It's against the people that work the hardest, that make the sacrifices, that do the savings, that do the investment, that keep the economy going. That is who the war is against. And unfortunately, the workers might win that war and destroy all the employers. And the only employer left standing will be the U.S. government, which will employ a lot of people doing absolutely nothing. And so we will have a lot of work. That's what you get when you have a war against employers. You get a lot of work, but nothing to show for it because it's non-productive work. It's government work. So you spend all day working, and then you've got nothing. You've got nothing to buy with your worthless wages because you're paid in a worthless currency. And that is the direction in which we are now headed, thanks in large part to the Jimmy Hoffas of the world. Anyway, let me go back to the phones. I got another Jim calling. This is Jim from Gibson, Montana. Or no, about Jim calling about Gibson Guitars from Montana. Jim, welcome to the show.
Hey, Peter, how you doing today?
Good. How are you?
Good. Hey, I really appreciate your show. You're about the only voice of reason on the whole media spectrum. It's just unreal, all the stuff that's floating on around there. Anyway, about this Gibson guitar situation, I got to looking on the internet, and I figured, what's the motivation behind it? And the only thing I can think is that it's political because Martin apparently is a big Democratic supporter and Gibson's a Republican supporter, and it makes me wonder if it isn't political.
Yeah, who knows? Now somebody emailed me. They thought it might have been an environmental issue, that maybe some of the wood that they were using was somehow endangered or, I don't know, coming from a part where there was some environmental impact. So maybe it's the environmentalists that are behind it. Who knows?
I guess Martin uses the same kind of wood, though. How come they're not under scrutiny?
Hey, there is no rhyme or reason to it. This is just government attack dogs doing what governments do, which is destroy. That's what they're doing.
Yeah. Anyway, I'll let you go, and I appreciate your show.
Yeah, thanks. Thanks a lot for calling. Next up is John calling from Connecticut, a local caller. John, welcome to the show.
Yes, hello, Peter. Thanks for taking the call. I just wanted to know what is the Fed trying to do with this idea of Operation Twist, where they're buying the long-term yield and selling the short-term yield. I mean, this is a potential strategy. Are they trying to flatten the yield curve?
Well, what they're trying to do is bring down longer-term borrowing costs, which would impact mortgage rates for people who are buying, who are using fixed-rate mortgages, which are very popular. So what the government is trying to do is make it cheaper for Americans to borrow so they can spend more money. That's all. But that is not going to stimulate real economic growth. The country is in trouble because we spent too much money and borrowed too much money, and making it easier to borrow and spend inhibits the real solution. But what it does do is it buys some more time for the politicians to get reelected. But that time is very costly to the U.S. economy. And as I said earlier in the show, the more long-term debt the Fed has on its balance sheet, the harder it is to shrink the balance sheet, and the more painful it is to the economy because it has to sell those bonds back into the market. And the question is, who's the buyer and at what price? When they have short-term debt, they don't have to sell. They just let it mature.
But why are they selling the short-term debt then? I mean, you've heard of this idea of Operation Twist.
They have to if they're not going to finance it all by printing new money, right? If they're going to try to create a little bit less inflation, then what they're going to do is, rather than expand their balance sheet that dramatically, they're simply going to alter the duration of that balance sheet. And so they're going to sell or allow to mature. Maybe more appropriately, they'll simply allow their short-term debt to mature. They won't roll it over, and then they'll reinvest the proceeds on the maturing short-term debt into the longer maturity debt. And so the duration of the balance sheet ends up lengthening.
Okay.
And if they do that, yes, they can temporarily drive down the long-term rate. But in the long run, the long-term rate is what's most damaged by the Fed's actions. Because the long-term rate, remember, is money the government doesn't have to pay back for 30 years. And that's 30 years of inflation, of dollar declines. And so ultimately, the inflationary monetary policies that are necessary to finance Operation Twist will ultimately put the squeeze on the long-term rates more than the short-term rates.
Right, I understand. Could I ask your opinion about the Swiss National Bank's move this morning to basically cap their exchange rate against the euro?
Yeah, I guess you missed. Maybe you should go. I addressed all that, both these issues, early in today's show. You might not have been listening at the first segment, so you could probably go to the archives if you sign up for a premium member. But I think it's terrible. I think what they've done is basically they've made a major mistake. They've bowed down to political pressures. Some of it is probably coming from the Eurozone, I believe, but some of it coming from certain Swiss exporters. But ultimately, it is bad for the Swiss economy. It's bad for the Swiss citizens. In the short run, today, it's good for the dollar because anything to undermine the Swiss franc, makes the dollar look stronger by comparison. But I do believe that these actions will actually hurt the dollar because they support the euro. Because now the Swiss franc, the whole Swiss economy, is brought into the Eurozone basically to help bail out the rest of Europe. So now Germany has Switzerland as an ally, and that the Swiss citizens are now going to have to bear some of the bailout costs along with German citizens. So it ultimately makes the bailout more palatable for the Germans. And I also think what Germany accomplishes here is probably the single currency that the Germans most look at as a reference point is the Swiss franc, more so than the dollar. So the relationship between the euro and the Swiss is probably very key on the mind of German voters. And so now that the Swiss are undermining their own currency, it makes it harder for the Germans to see the damage that's being done to their currency now that the Swiss are damaging their own. But obviously, the Germans who are paying attention to the price of gold, will just see a bigger rally. And, of course, all of this is bullish for gold. And as I said, I wrote my article in my newsletter, The Last Safe Haven Standing, which just came out last week. implying that, the only safe haven remaining will be gold, as all the current countries undermine their currency. As what we are really watching is the unraveling of the fiat monetary system. It is disintegrating all over the country. It is unworkable because even the countries that pursue sound policies are now going to abandon their sound policies and pursue reckless policies because they don't want their currency to go up against the others. And so when you have a race to the bottom, that's an easy race to win or an easy race to run because everybody's competing for coming in last. And, of course, the victims of the currency war are all the citizens that own these currencies. They are the casualties in the war because they all get killed. And I said a currency war is the only war where you turn your weapon on yourself and pull the trigger. And whoever kills themselves the most, I guess, is declared the winner.
All right. Well, thank you for taking the call.
Yeah, thank you for calling. And, looking about, this crazy policies that we're continuing to pursue, I'm looking at, again, I got some sound, and I'm probably going to play it after the break because I know we're going to run up against a commercial. But this is on MSNBC's Morning Joe. This is one of our congressmen, Representative Debbie Wasserman Schultz, advocating on MSNBC about why we need more stimulus. And she points back to the fact that she believes that the last round of stimulus worked. And because it worked, that's why we need more. Well, if it worked, we wouldn't need more. I mean, when are people going to start to realize that the reason we have a hangover now is because we got drunk, right? We got drunk last night. So the stimulus didn't work unless you think that alcohol works because it makes you drunk. And when you're drunk, you feel better. But the result of drinking and that temporary high is the following hangover. We have a hangover right now from the last round of stimulus. More of the hair of the dog is not the solution, but Congresswoman Wasserman thinks it is. We're going to play some sound from her on MSNBC when we come back. So stick around. You're listening to the Peter Schiff Show on SchiffRadio.com.
The Peter Schiff Show. Since the Peter Schiff Show was last on the air, the national debt added another $7.89 million.
Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
And we are back, and before the break, I teased a bit about this Wasserman comment on stimulus. Let's go right to cut number 6.
The Recovery Act had a direct impact on making sure that teachers, firefighters, police officers were able to remain in their jobs. It helped begin to turn the economy around. 50% of it was tax breaks to small businesses and to the middle class. So every economist you would talk to that is worth their salt acknowledges that without the Recovery Act we would not be continuing on the upswing. We would still be it's either stuck or spiraling downward. So the Republicans can't make up their own facts. The bottom line is the Recovery Act had an impact. We need additional impact, like an infusion, I think, of infrastructure, but a combination, which is what I think the president will propose on Thursday.
Yeah, well, the problem is the Recovery Act did have an impact. It made the problems bigger. It made the problems worse. But, yes, temporarily, as we spent more borrowed money, it felt good. As I said, I made this analogy before, doing drugs or drinking alcohol can feel good. That doesn't mean you should do it. That doesn't mean it doesn't have any negative consequences when the drugs wear off, the hangover sets in or whatever. That's where we are. And she's talking about every economist worth their salt. Well, not every economist. Obviously, she's not talking about the economists that know anything. Maybe all the economists that are clueless, all the Keynesian economists, maybe all the economists who completely missed the recession in the first place and couldn't even see the financial crisis even when it was staring them in the face. Maybe if you ask all the economists who have gotten it wrong year after year, yes, maybe they'll all agree that we need another stimulus. But if you ask any of the economists who have gotten it right over the years, they would probably be in agreement that the last thing we need is another government sedative disguised as a stimulus. Hey, talking about other scams, I wanted to give another update on the pump and dumpers over at National Inflation Association. They're up to their old tricks again. The same old stock. They dusted off the strip on this stock, Agri Corp. Again, I'm not recommending anybody buy or sell this stock, just trying to describe how a pump and dump works. When they first recommended this stock and they charged people $1,000 to buy it, the stock was at like 87 cents, and it immediately gapped up. And all the people who paid $1,000 paid $1.58. That was the opening print. They did like 500,000 shares. That was like 20 times normal volume, and it proceeded to sell off, and it went straight down 60% to 63 cents. It stayed down there for a couple of weeks. My guess is that the guys behind the NIA, Gerard Adams and Jonathan Levitt, after they dumped all their shares on that opening day, despite claiming that the NIA itself didn't sell any shares. Of course, the NIA didn't sell their shares, but I bet Levitt and Adams were unloading all their shares, and whoever paid them to also pump and dump the stock. When the stock got way down to that 70-cent level, 60-cent level, they accumulated, I bet, for a couple of weeks. And then as the stock started to move higher, they probably pushed it higher by buying more, all the while knowing that they had an exit strategy. The exit strategy is another pump and dump. So what they did over the weekend is they bombarded my inbox telling me how much money the people were already making. The implication of their emails was that the people who paid $1,000 to buy this stock were way ahead, that the stock had gotten way up. And despite the fact that the stock market was down, that the people who followed their advice were making a lot of money. They weren't. The only day that the stock has been higher than where those people paid to buy it was today. And the reason that it's higher is because more NIA people are buying it. Now they charged only $500 for the privilege of being ripped off. Last time around they charged everybody $1,000. Now they're charging people $500 to fall victim for the same scam. Now the stock is not reacting as the way it did the last time. It hasn't completely fallen out of bed. It gapped up, and it's still at those levels right now. It hasn't rolled over yet. But my guess is it's the same old con. And, it's the same thing. I mean, just like their stock, Mega Precious Metals, they keep on touting it. They're trying to say how much money people are making in this stock. It's really gone nowhere. And, in fact, in the last 2 weeks, since the last time they really hyped this stock up, while the gold index, the HUI index, has gone up over 8%, their favorite gold stock is down 27%. And that's because it's not really a gold stock. I mean, the price of gold has nothing to do with a speculative company that doesn't really have any gold. What makes it go up is hype and promoters. And the reason, again, I bring it out, I don't want anyone to fall victim to these scams. But the thing is, this is basic pump and dump 101, run by a guy who is the poster boy for pump and dump. Because if you look up pump and dump on the Internet, there's actually a picture. The first listing you get is Jonathan Levitt. I mean, the old joke, if you look up Jonathan Levitt, if you look up pump and dump in the dictionary, there's a picture of Jonathan Levitt. There is. If you look him up on Wikipedia, it's his picture. And I handed this to the SEC. I told them exactly what these guys were doing, yet they've done nothing. So maybe that's more proof that we should dismantle the entire SEC. There's no reason for it. If they can't put out of business an obvious pump and dumper like this, what good are they? Anyway, let me go back to the phones. Next up is Andrew calling from Toronto.
Hi, Peter. Thanks for taking my call.
Hey, thanks for calling.
I've got a question. What are your thoughts on the allegations of fraud levied at Silvercorp last week?
Yeah, again, I can't give out any investment recommendations, so I'll talk a little bit about it. I mean, I do own this stock. I own a lot of gold and silver stocks, so I own it personally. But, again, the fact that I own it doesn't mean I'm recommending anybody else buy it or short it. But I will talk a little bit about the fraud allegation because, Silvercorp, their properties are in China. And there has been a lot of fraud recently with some of these Chinese companies that did reverse, mergers into U.S. shells. And one of them that was very popular was, of course, this an agriculture company. I'm forgetting the name of it, but there were some big hedge fund players were in it. The stock collapsed. And there's been a few high-profile companies, Chinese companies, where there has been fraud. And so I think a lot of Chinese companies are being unfairly painted with the same brush because I don't believe that that all these companies, there were this suspicion of fraud, there actually is. And my guess is that Silvercorp Metals is the same thing. I mean, it's really a Canadian company. The company was in business, long before a lot of these the fraud companies did their reverse mergers. That's not how Silvercorp Metals made it onto the U.S. exchange. And they have U.S. auditors. They are a producer. They actually produce gold, and they have a lot of earnings. They pay a dividend. So, my gut feeling, obviously I own the stock. I haven't sold my shares, so I obviously don't believe that the allegations are true. But it doesn't mean, look, obviously it's possible. I mean, I think there are some short sellers out there. Some of the allegations have come from unnamed sources. So, obviously, if somebody is shorting a stock, they might have a vested interest in disseminating information, even if it was false, to get the price of the stock to go down so they can buy it. But my guess is that the allegations are not true, but it's just a guess based on research that we've done on the company. But again, I'm not recommending it. If people want to find out what I recommend, they need to call the firm directly. Anyway, hey, that's the end of the show today. We'll be back again tomorrow for another 2 hours of the Peter Schiff Show on SchiffRadio.com, the gold standard.